In this section, we're going to discuss why we use technical analysis. Really, it's necessary for timing and risk control, but it's very misunderstood. So what are we really doing with technical analysis? We're always reading demand and supply, and this allows you to develop a thesis which allows you to control your risk, because you'll know when you're wrong. Let's take a quick look at an example of Roku here. As you'll see, there are a number of kicker patterns that take place along this massive uptrend. Now, with each of these kicker patterns, which we'll discuss later, there's a very easily identifiable exit point where you know the pattern is wrong. And the ability to have entered into this major uptrend with these small identifiable risks is really a major advantage over somebody who's buying the stock without any kind of risk control. Because when you know where you're wrong, you know when you can exit the trade and use your capital for other purposes. So the key reason to use technical analysis is really to control that risk and reward dynamic. And that's so integral, it's so important, and volatility completely impacts that risk to reward relationship. It's a core principle that non-pros miss out on, and it drastically changes performance. If I'm looking at a stock and I'm considering an entry, but each day has a daily range of 10 or 12%, which some of the very actively traded stocks have, if I'm looking for a stock that's going to deliver 5 times my risk, well, 5 times that 10% daily range, which is a reasonable stop point, would mean that I have to expect a 50% return to take that trade. Now that's not very likely in the marketplace, so I will probably pass on that just because of the risk-reward relationship. And no other tool really allows you to take control of this relationship quite like technical analysis does. So really, welcome to the active part of the active growth investor method. We're always trying to maximize that risk versus reward. So how do I use technical analysis? Well, as a market maker, I noticed a major gap between how day traders and position traders approach the marketplace. Oftentimes, position traders or people getting into these trends would be buying stock just as I, as a day trader, would be selling that stock. And often, I would sell my stock way too early, as institutions were about to go on a buying frenzy for months. I mean, because really it's the institutions that drive these moves. So as a market maker who also understood trend following and William O'Neill's method of CAN-SLIM, it allowed me to start to deconstruct the charts to their core. My approach really became, I want to think like an institution, but as a floor trader at the same time. So how do I accomplish this? Well, it became clear to me that the patterns that were identified by William O'Neill in the 1980s in his investment classic, How to Make Money in Stocks, were really the bases that created these long sustained moves and showed the footprints of these institutions that were accumulating the stock. And they really shaped the trend. That's why I call them shapers. Really, bases are just too generic, and these bases identified by William O'Neill are much more significant. And when I want a viewpoint of institution, I review shapers and I review the fundamentals, which together help to identify major future stock trends. But despite this, I noticed a major drawback to using only these shaper patterns as my buying tools. Active individual investors really are weak hands. The fact that we're going to exit a position with a quick stop if we're wrong means it's very easy to get us to sell our stock. And the risk is larger because volatility increases at these shaper buy points, which often results in quick, frustrating losses. Also, if you're stopped out, it's hard to find a re-entry. And if you miss a proper entry, you need things to kind of reset up, which may never even happen again. And one of the 2 biggest mistakes you can make in the market is taking a loss that's too big, but it's also missing out on a major opportunity because those don't come around too often. So the reason for these quick losses is that a lot of these entries are fairly obvious and they're above prior highs. And it's really where short-term traders will want to fade people kind of running into the marketplace chasing these patterns. And so you can fade these investors because you know they're weak hands and you can push them out for very quick profits. So I realized just as institutions can buy for weeks on end, if I was smart and tactical, I could find multiple points to buy a stock and not be exposed to these quick shakeouts by entering at the same place that most people do. For years, I lived off of these short-term entries, and most of these profitable short-term entries are less obvious and often counterintuitive. So what I did is I compiled these short-term tools into groups which I call tactical patterns. The active growth investor strategy uses these tactical patterns within and around shaper patterns for optimal entry as major trends look to be developing. When we combine these shaper patterns, which identify major possible advances, with those tactical patterns that allow for timing and limited risk, you develop agility and you allow safe concentration, and it becomes so powerful. Sure, there are a lot of moving parts, but you end up with a small controlled risk and large upside, and that's the recipe for high performance trading. Let's look at an example, Sea Limited. to get a visual as to how this works. So you can see here that there's a cup with handle forming, and we're going to get into the details of that later, but you can see the outline with the large green cup and handle on the chart. And all of those small purple arrows really point to all of these tactical entries that you could have used on the right side of that cup to have entered tactically. So rather than wait for that one entry that develops as a result of that cup with handle pattern, you could have used the general shape and characteristics of that cup, which identified institutionals accumulating, but timed that with all those little tactical patterns to deliver multiple entries and limited risk. So the active growth investor approach allows for this agility, which traditional growth investing doesn't. It allows for tighter risk, which results in smaller drawdowns, multiple opportunities to enter a stock, safer concentration into a winner over time, a reduction in the liquidity impact. And that's a key component, because if everyone is rushing into a stock at the same buy point, liquidity starts to be a rather important element that you have to address, because as everyone rushes into that same stock, spreads start to widen between bids and offers, and the volatility increases as a result. So reducing your liquidity impact as a person or as a set of people applying a strategy is really important. And that's why so many people applying a rather obvious or well-known strategy really run into these repeated losses, as everyone's kind of running into the market at the same time and they're faded by these professional investors. Beyond the liquidity impact, the fact that you're using these small tactical patterns can often result in a small profit despite minimal follow-through, because your risk is so limited and a lot of these patterns are really designed for immediacy. When you have all of these tactical patterns and you can build your position over time, you're never fully exposed with your full position when you enter. This really provides safety in the event of a gap down. And trust me, if I can promise you anything, that a gap down will happen to you as soon as you buy a stock at some point. I can't tell you how many times I bought a stock at $3.59 and shortly after, bad news or a downgrade came out on the stock. So you want to really protect yourself when you are building your position, because some of those gap downs can be rather devastating if you're really moving with a large amount of your capital all at once. As well, the ability to have multiple entries really eliminates that FOMO. You know you can get into that stock because you have so many ways to buy that stock, so you're never really worried about missing that one great entry. I remember when I first started learning to use these types of methods, not having enough buy signals left me feeling worried that I would miss that proper optimal buy point and I'd miss the entire advance. So having all these tactical patterns really removes that sense of FOMO and that you're going to miss out on this great opportunity. Of course, no system is perfect. There are some drawbacks to the active growth investor approach. It really takes more attention. But look, if you want big gains, it's going to take more work. But I think we're all here to make those big gains, and I don't think work is going to be the problem that we have to overcome. One of the issues that I think that really you have to pay attention to is that it may prevent over trading, because you have all these tactical patterns and you're going to want to use them. And that's why you can't use these tactical patterns in isolation. You want to anchor all of these patterns around shapers. Shapers are really the core of the entire strategy. It's what keeps you focused, it prevents over trading, and it really helps you to identify these high quality stocks. These shaper patterns don't occur every day. It takes weeks for them to develop. So if you're patient and you look for these quality setups, it's really going to restrain you from just chasing any stock that looks interesting.